Welcome to my 2022 mid-year recap. Over the years, I have shot hundreds of videos, but I don't recall ever shooting a video with this much content. As I look back to the beginning of 2022, the optimism from consumers to investors to economists has changed drastically. There are so many headlines that I would like to break down this video into each of the major headlines that's occurred over the last 6 months, and I will comment specifically on each headline. Number 1, the Russian invasion of Ukraine. Number 2, inflation reaches 40-year highs. 3, the Federal Reserve prepares double-barrel tightening. 4, the stock market enters bear market territory, pushing stocks to their worst first half return in 50 years. And 5, the Housing Affordability Index drops to its lowest levels since 2006. And lastly, leading investment strategists and economists' opinions vary for the balance of 2022. The first headline, the impact of the Russian invasion of Ukraine. On Thursday, February 24th, after months of tension and military buildup, Russia invaded Ukraine. It was the first major war between European nations in decades and brought significant humanitarian and economic ramification for the entire world. When it comes to the global economy, Russia and Ukraine are key players. For example, both together comprise 29% of the world's wheat. Ukraine alone is one of the largest producers of corn, while Russia is Europe's largest source of both oil and natural gas. As a result, we saw commodity prices rise, including gas, natural gas, and food. This decrease in supply increases the overall bottleneck that we saw in the supply chain issues across the world, sending prices higher and ultimately raising inflation. Second headline is that inflation reaches 40-year highs. In the Federal Reserve's June 14th and 15th meeting, they voted to raise the benchmark Fed funds rates by 0.75% in June, which is the largest increase since 1994. Last month's rate increase lifted the Fed funds benchmark rate to range between 1.50% and 1.75%. The overall tone of the minutes from the meeting suggested that the Fed upgraded the inflation problem to, quote, a 5-alarm fire, said Omar Sharif, an economist and head of the advisory firm Inflation Insights. Consumer prices rose 6.3% in May from a year earlier, according to the Fed's preferred gauge, the Personal Consumption Expenditure Index. A separate measure, the Consumer Price Index, was running as high in May of 8.6%, which is the new 40-year high. The third headline, the Federal Reserve prepares double-barrel tightening with the bond runoff. To support the financial markets and the economy during the pandemic, the Federal Reserve more than doubled its portfolio, mainly Treasury and mortgage-backed securities, to a record-breaking $9 trillion. On Wednesday, May 14th, the Federal Reserve announced plans on how they will shrink the balance sheet. The Federal Reserve first undertook large-scale bond buying programs referred to as quantitative easing, going back to 2007 and the 2009 financial crisis, at a time when the Fed funds short-term interest rates was near zero. The purchases were designed to stimulate the economic growth by lowering long-term interest rates. In 2017, when the Federal Reserve concluded the stimulus was no longer needed, it began to shrink its portfolio by passively allowing the bonds to mature without reinvesting the proceeds, rather than actively selling off the bond portfolio in the open market. It is estimated that the Federal Reserve will allow $95 billion in bonds to mature every month, nearly double the amount of last time. One of the biggest differences between now and in 2017, when the Federal Reserve allowed their bonds to run off their balance sheet, is that the Fed was not in a rush 5 years ago because inflation was running just below 2%, unlike the 8.6% we see today. The fourth headline, the stock market enters bear market territory. On Monday, June 13th, investors began the week by digesting a new set of news that inflation was continuing to surge. In response, the markets swiftly and sharply pushed the S&P 500 officially into bear market territory. A bear market is a drop of 20% or more from a recent peak. In this case, the recent peak went all the way back to January 3rd of 2022. On Friday, June 10th, a new consumer price index report showed that inflation rose higher in May than the previous month, as indicated above, to a rate of 8.6%, which is the biggest increase we've seen since 1981. This means the Federal Reserve now has a choice of 1, raising interest rates more aggressively and risk triggering a recession, or 2, continue the same measure and risk worsening inflation. Higher interest rates are a proven tool to fight inflation, as higher interest rates reward savings versus spending. And if America spends less, demand for goods and services go down, forcing companies to lower their prices if they want to attract new business. Lower prices, of course, means lower inflation. On the other hand, higher rates means higher borrowing costs and more expenses for both individuals and companies. If rates rise too high or too fast, it could trigger a nationwide layoff and a major sell-off in the housing market. Until now, we've had 3 bear markets in the 21st century. The first, in the early 2000s, lasted for 929 days. The second, the Great Recession, lasted 517 days. But the third, back in 2020, only lasted 33 days. The fifth headline, the Housing Affordability Index drops to its lowest level since 2006. Record home prices and higher mortgage rates in May made it the most expensive month since 2006 to buy a home, prompting more buyers to give up and pressure sellers to cut asking prices. The National Association of Realtors Affordability Index fell to 102.5 in May, the lowest level since 2006 when it was at 100.5. The index incorporates the median existing home prices, the median family income, and average mortgage rates. A decline in affordability makes it especially difficult for first-time home buyers to enter the home market. The typical monthly mortgage payment rose to $1,842 in May, up from $1,297 in January, and some buyers can no longer qualify for mortgages, while others are unwilling to pay hundreds of dollars more a month compared to what they had budgeted just a few months ago. And 6, leading economists' opinions for the remaining in 2022 vary significantly. After the worst first half stock market decline in over half a century, the Wall Street Journal asked 7 leading investors and strategists to share their outlooks for the second half of 2022. One chief investment officer said, quote, "We haven't seen risk assets go down this hard in at least 50 years. But the other side of the downturn like this are almost always significant bounce backs." He goes on to say, quote, "I don't recall the prices of good quality assets looking so attractive in years." Another chief investment officer said, "The Fed won't stop raising interest rates until they see inflation cooling, and service inflation won't come down until the labor market softens." Yet another economist says, quote, "The bear market has everything to do with the Fed, and the ship was pointed towards a massive stimulus back during COVID, and now the ship is towards tightening a financial condition, and it's going through its cycle. I think the only recession is likely may already be one." And another analyst indicated, "We won't see downward earnings revision fully priced in until the fourth quarter. Until we do, equities won't rebound. The probability of a recession is rising, but even our worst case scenario is for a mild recession." And lastly, an economist for one of the largest banks said, quote, "We're going to see a bounce. The threat of a recession has grown, and the economy is clearly going to slow down, but inflation will come down, prompting the Fed to slow down its aggressive hikes as well. Unless there's a shock, stocks and bonds can rally." As mentioned by one of the economists above, the Federal Reserve and the U.S. government has been steering this economic ship since the pandemic began in 2020. Both the Federal Reserve, with its monetary policies by cutting the Fed funds rates and aggressively buying bonds, and the U.S. government through its fiscal policies and its 3 rounds of stimulus, did whatever they needed to do during the pandemic to get the economy back on track and on solid ground. The problem? The Federal Reserve and the U.S. government created so much liquidity with supply chain constraints that too much money chasing too few of goods is a perfect recipe for inflation. We are now in a situation where the Federal Reserve is having to play catch up to slow the overheated economy to bring down inflation. So, what does all of this mean? I think there are several lessons to be learned from the past 2 years. The first is the importance and the impact the U.S. government and the Federal Reserve can have on our U.S. economy. Number 2, the Federal Reserve's main goal is to keep our economy growing at a consistent rate, and when the economy has extremes, either up or down, it uses its necessary tools to make the adjustments. And last and finally, as my last headline indicated, leading experts can't agree on the direction of the U.S. economy and where the markets will be at the end of the year. So it's important to remember that no one is accurate in predicting the future of our economy all the time. And as I shared with you earlier, bear markets can last as long as 3 years and as short as a month. While a bear market may be a signal to the end of a bull market, it does not signal the end of a sound long-term investment strategy.